Happy 2026, everyone, and welcome back to Miller Momentum. I'm so glad to be back from the holidays, and I've got some really cool stuff for you, so let's dive right in. But first, before we dive into SPMO and SPVU and how momentum and value can work together as factor investment strategies, a little disclaimer is in order. Listen, I am not a financial advisor, and this is not financial advice. I am just a guy on the internet whose investment strategy beat the global stock market over the past decade and who is now currently outperforming the S&P 500 for the moment and has done this with less risk than the market overall. But listen, the content in this video is for entertainment and educational purposes only. Past performance is not indicative of future results for any of the strategies that I overview. So keep in mind that investing involves risk always, and you need to do your own research and come to your own decisions. Before we get into the nitty-gritty of momentum and value investing strategies, let's take a step back and look at the evolution of equity investing. So, there is a traditional capital asset pricing model view that posited a single factor, just market risk, can explain all expected returns. Under this view, the only way to get higher returns was just to take on more broad market risk, say with leveraged ETFs, borrowing money so that you can buy more shares than you would otherwise with just your own cash on hand. Well, that view has been replaced gradually by factor investing, sometimes referred to as smart beta or strategic beta, that goes beyond some of the views that were pioneered by Jack Bogle. Research by Fama, French, and Carhart dismantled the CAPM view of the world, that is the capital asset pricing model, proving that specific characteristics like momentum and value can drive long-term outperformance. These factors reward investors for enduring specific behavioral or structural risks. Something that you may find in older books on finance, they would call it speculative value, but it is nevertheless real value and arises from the fragilities of human behavior, shall we say, which can turn to quite a profit. And that brings us to the deconstruction of the momentum strategy itself. How does it work? 3 things: trend persistence, underreaction, and herding behavior. So trend persistence is piggybacking on assets that have done very well in the recent time frame. Winners will tend to keep on winning due to fundamental strength and investor psychology. And that ties into underreaction. So investors as a whole react to old prices and move slowly into new prices and take time to incorporate positive information like earnings surprises. That can cause prices to adjust gradually rather than instantly. So the market is never entirely efficient, and momentum takes advantage of those inefficiencies and lags. It also takes advantage of herding behavior. As trends mature, institutional mandates and the fear of missing out, FOMO, attract capital to rising assets and extend those valuations beyond fundamentals. And they can extend quite a bit. Everybody is afraid of bubbles, but the truth of the matter is, if you have a good strategy, bubbles can be profitable to you. Moving from the general to the specific, let's talk about the index methodology of the S&P 500 Momentum Index in particular, which features in my own Miller Momentum flagship strategy, and will also feature in the investment strategy that I'll talk about today in this current presentation. So, how does it work? It selects the top quintile, or 20%, of the stocks in its base index. For the S&P 500, that would be about 100 stocks, 20%, with the highest momentum score. It does a 12-1 look-back procedure, so it uses 12 months of returns but excludes the most recent month to avoid the short-term reversal effect. And then it has some volatility adjustment controls built in. So raw returns are divided by daily volatility, and that will penalize high beta speculation and reward smooth, consistent trends. Now, the S&P 500 Momentum Index ETF, SPMO, and its siblings, XMMO for the mid-cap index, XSMO for the small-cap index, IDMO for the international index, and EEMO for the emerging markets index, they all use semi-annual rebalancing. This creates lag, but it also reduces turnover costs compared to monthly rebalancing strategies that, unfortunately, when you rebalance that frequently, will tend to eat up all of the excess returns that you're trying to get. So let's take a look at the recent elastic, bouncy behavior of SPMO itself since 2022. So in 2022, it started out with a negative return, pretty comparable to the S&P 500 on which it's based, but a little bit lighter because it actually balanced into financials and energy stocks during that very crushing year. And then you see in 2023, it's going back up, but it takes a while to gain that momentum. So it's lagging its base index in 2023, but then by 2024, holy smokes, it just goes way past the S&P 500 index, and that's what momentum is all about. It lags in those early recoveries, but then shoots through the roof once a definitive trend has established itself. The value factor, on the other hand, is in many ways the exact opposite of momentum. It is literally momentum shadow. So momentum is about buying recent winners without any regard to their fundamentals, and value is about buying recent losers with strong fundamentals. So you're going to hear people on YouTube sometimes claim that the value factor is a safe way to invest. You're investing in safe, boring stocks like financials and energy and whatnot. Some of them will even posit that the value factor can be a bond substitute. This is nonsense. Don't fall for it. The value factor can actually have steeper drawdowns than just a broad index fund, because you are buying the hated stocks that people are shying away from. It's counter-cyclical. So momentum exploits underreaction, value exploits overreaction to distress. You're getting not boring stocks necessarily, but stocks that are out of favor. And it's entirely possible in the future that tech stocks could become primarily value factor, whereas utilities or energy could become the stocks with momentum. It's all relative. But anyway, the enhanced methodology that the SPVU ETF uses, unlike generic value indices, takes the top 100 stocks with the highest value score based on price to book, price to earnings, and price to sales and other different characteristics. Now, the role in a portfolio is that it can act as ballast when momentum fails. It's a relative ballast. That's important to remember. So when momentum crashed in 2022, SPVU held firm, so it lost about 5.4% of its value compared to the market drawdown of about 18%. And that was driven because it was already in energy and financials before momentum had a chance to rotate into that new emerging trend. So the value factor is great at catching tomorrow's trend today. So why combine them? Well, correlation and divergence, as you might have already guessed. Momentum and value exhibit low to negative correlation of excess returns. They almost never work at the same time, and that's a really good thing because momentum typically thrives in low rate, stable growth environments like 2017 and 2024, and value thrives in high inflation, rising rate, and recovery environments like 2022. So combining these two strategies creates a barbell style portfolio that smooths volatility without sacrificing returns. And in my own Miller Momentum flagship strategy, I actually combine value with size because it tends to be strongest in smaller cap stocks that get overlooked. So I pair momentum in large and mid caps with value in small caps. Now, this is not the strategy that I'm presenting in this current presentation, but it helps to note that you can mix and match these strategies in a lot of different fun ways. So that brings us to the 50-50 barbell approach that's actually discussed in the S&P Global Research paper that I've got linked in the description of this video. Be sure to check that out. And this strategy is just allocating 50% to SPMO and 50% to SPVU. It captures both tails of the market distribution, the recent winners without regard to their fundamentals, and the recent losers with strong fundamentals that shouldn't have really lost if you think about it. So, sleeve blending. This strategy holds separate ETFs, allows you to capture deep value and expensive growth simultaneously, and when you rebalance, you sell high and buy low across the two sleeves, and it avoids integrated funds like ETFs that combine value and momentum within themselves, which just really hasn't worked out as well as the research literature thought that it would. Because actually it turns out that keeping these factors separate is much more effective because of that rebalancing effect and also harvesting Shannon's demon, which I talk about in another video. So be sure to search for it on my channel. It's quite spooky. So let's look at a little case study here. So the 2022 to 2025 market cycle. Gosh, it's incredible that we squeezed a whole market cycle into a space that short. Usually they span over a much longer period of time. But anyway, in 2022, we had the inflation shock. So SPVU was in the lead and winning as rates spiked. Momentum pivoted to energy mid-year and mitigated losses. So a blended strategy between the two would have resulted in a significantly softer landing than just being entirely in the S&P 500 as a broad market cap index. Then in 2023, there was the growth rebound. Momentum crashed. That is, it lagged during the recovery. It didn't go negative. A momentum crash for a long-only strategy is rarely negative. It just means that it doesn't pick up steam as fast as the broad market does. Anyway, it was stuck in defensive strategies while AI tech rallied. And those AI tech companies in 2023, guess where they were? That's right, they were in actually a lot of them in SPVU, because at that point in time, they were the value stocks. They were the recent losers whose strong fundamentals suggested that they were hated without a cause. Anyway, zoom forward to 2024 and 2025, and we enter the current momentum super cycle. Trends were firmly established at the start of 2024, and so momentum ETFs just rocketed off the charts. So where are we at as of 2026? Well, momentum is stretched, quite frankly. The optimal move then is to trim outsized gains from momentum and redeploy into value. I use a 5% absolute band rebalancing strategy on my Miller Momentum flagship. And with the way that I've constructed my Miller Momentum flagship portfolio, I never have to worry about timing the market. I've just got 10 ETFs, each one with 10% in it. And whenever any of them strays by about 5% from that mark, I just rebalance the whole thing. It's that simple. Let's look at some key takeaways from this presentation. So first, momentum works. SPMO delivers significant excess returns over full cycles, but is prone to crash risk during reversals like 2023. Again, look at the paper that I've linked in the description, and you will find a back test of SPMO going all the way back, way past the year 2000. So that's a little treat for you all, because I know a lot of people on YouTube are always asking, well, okay, SPMO has done well over the past 10 years, but how would it have performed during the dot-com crash or during the great financial crisis? Well, now you don't need to fret about that, because we actually know exactly how it would have performed. We've got the index stretching back before those dates, so take a look in the description. Anyway, value protects. SPVU provides critical downside protection during inflationary and rate hiking regimes when momentum fails. But this protection is relative. It is a ballast when combined with a strategy like momentum, not on its own, not as a quote-unquote bond substitute like people on YouTube like to think. Anyway, separation is key here when you're doing factor investing strategies. I use separate ETFs always instead of using blended sleeves. Sleeve blending, not blended sleeves. So I don't like integrated funds because I want to maintain factor purity. And then, of course, there's rebalancing. I use 5% absolute bands on my Miller Momentum flagship strategy. It helps me avoid overtrading, and rebalancing forces you to buy low and sell high. Well, thank you for watching Miller Momentum. I hope you enjoyed the video. Don't forget to like and subscribe and leave me a juicy comment. Hey, let's get rolling.